Hi everybody, this is James Tompkins and I want to get into my fifth lecture of this corporate finance series, and that is the discount rate for financial securities, otherwise known in a lot of textbooks as risk and return, because it's a lot about, guess what, risk and return. So I want to start off the way I usually start, and that is with the agenda. And what I'd like to do is to get into, or just to remind you, even though this is in the first lecture in the introduction to corporate finance, I want to get into why I'm doing what I'm doing. As I mentioned, I'm not well, we're going to do this topic because it's in Chapter 5 and Chapter 5 follows Chapter 4. Okay, I like to have maybe more specific logic that's more specific to this class as to why I'm doing what I'm doing and the order that I'm doing it in. So once we get through the big picture, then we'll jump into this topic, risk and return. So there you see the representation of the firm, and as I mentioned in lecture 1, from this perspective, what two big picture decisions do you see that a company makes? Well, what about this guy right here? Well, that's what I call the asset investment decision. You know, other firms, other textbooks and so on and so forth may refer to it as capital budgeting. But basically, the asset investment decision is what a company spends their money on. That's their business plan. That's like Apple deciding to invest in the iPhone, or me deciding to invest in a lemonade stand. Okay? Now, what's the other big picture decision you see? Well, the other big picture decision is the financing decision. Now, is the financing decision, well, I wonder if I'll raise money or not, because after all, finance means to raise money, right? So, for example, when you bought a car, you might have, quote unquote, financed it, which meant you borrowed some money to pay for it. So, is the financing decision, well, I wonder whether I'll raise money? It's not, right? Because that's a given. If you're going to spend money on something, i.e. the asset investment decision or your business plan, is it a given that you have to raise money? You do, right? So the financing decision is not, well, I wonder if I'll raise money or not, but rather it's given that I'm going to raise money, what will the structure of that capital look like? For example, will I have no debt and all equity, or will I have 400 in debt and 600 in equity, and so on and so forth? Then, in the introduction, we talked about, well, which decision is more important? Is it the asset investment decision or the financing decision? Well, what we argued is that the asset investment decision is more important. So, for example, if you look at why Apple stock has, in the long run, done really well, especially since Steve Jobs rejoined Apple. Basically, they totally reinvented how music was sold with iTunes, and that risk paid off. And then they got into the iPhone business and the this business and the that business. Are all those examples of asset investment decisions? They are, right? And if you'd invested in Apple back in, say, the early 90s, you'd be pretty happy right now. Now, what about the financing decision? The other day, Apple announced, hey, we're going to buy back 14 billion of our stock. Well, when they buy back 14 billion of stock, does that change the capital structure? It does, right? So that's a financing decision. And while Apple stock may have reacted, do you think it's reacted even with anything remotely close to the same degree as all these successful asset investment decisions they've made? And it hasn't, right? So this decision is important. I mean, I'm not undermining this decision at all. In fact, what I call part 2 of corporate finance, we get into this in a lot of detail in the advanced corporate finance class. However, you could make the best decisions in the world on this side, but if you have a bad business plan, guess what? What's going to happen to you? Well, you're heading in the direction of bankruptcy. You could argue Enron, for example, had a flawed business plan. So my goal in this class is basically the theory and practice of the asset investment decision. And there's a roadmap for that. And the roadmap is right here. So we begin with measuring value, then the asset investment decision, valuing stocks and bonds, discount rate for financial securities, discount rate for the asset investment decision. And what I'm going to do now is just remind you why this is a roadmap. And so in lecture 2 of this series, what is really the first topic, I'm not counting the introduction as the first topic, we began with a model for measuring value. And what was the name of that model? It was the time value of money. So why have a model to measure value? But why was this our first topic? Well, if we're analyzing decisions that create value, or we find out they destroy value or whatever, do we need to be able to have a way to measure it? We do, right? So if we're going to manage value, it certainly helps to be able to measure value. So in the time value money model, do you recall what 2 things did we need to value anything? Well, we needed cash flows and a discount rate. So let me illustrate. For example, if the discount rate were 10%, then what would be the value of this $110 today? Well, from single cash flow principles, I'd take that 110 divided by 1.1 and get 100. So therefore, the 2 things that I needed to value anything, did it include cash flows? It did, right? And did I need my discount rate? I did, right? So the 2 things I needed to value anything was cash flows and a discount rate. Now that's going to be important to remember as we now start applying this way of measuring value throughout the rest of the course. So the next topic was the asset investment decision. Like I said, most books refer to it as capital budgeting. I call it an asset investment decision because, and I'm not denying capital budgeting is a bad way to put it, but I call it an asset investment decision because that's literally what you're doing. When a company spends money on land or plants or buildings or even a CEO, I know you don't put a CEO in accounting on the balance sheet, but from a finance perspective, is that an asset investment decision? It is, right? It's something you spend your money on. And so in the 3rd lecture of this series, we basically applied a way to measure value to the asset investment decision. And do you recall what in theory had to be true for an asset investment decision to create value? What was the bottom line analysis that said, hey, if this is positive, then at least with respect to what you quantify, then in theory this should create value. And that was net present value. So just really quick to illustrate, if we have an asset investment decision right here, you spend $1,000 today and it's expected to reap $1,200 down the road, and then that's the end, and the discount rate that applied to this asset investment decision were 10%, then basically the MPV, bringing everything back to time 0 and netting it out with this 1,000 would be $91. And so in theory, assuming the market is efficient or that flow of information is priced in an efficient manner, then how much would firm value have gone up by? And that's about $91. And when would it go up by 91? Well, at what time does this 91 reflected? We're bringing everything back to time 0, right? So that would be $91 at time 0. That's why, for example, when Apple announces, hey, we got a new iPhone, and they haven't sold a single new iPhone yet, but they just announce it, what happens to the stock price? Well, it reacts, right? Because it reacts to the market's expectation of future expected cash flows and or the risk inherent in those cash flows. And it reacts today to that expectation. But again, for this positive MPV or for this net present value, what 2 items did I need to value this decision? Well, cash flows and discount rate. However, when we did that topic, we basically assumed that we knew the discount rate that applied to the asset investment decision. That's a pretty big omission, right? I mean, we've argued that the asset investment decision is arguably the most important decision a firm makes. Then we've said, hey, net present value, which is sort of some bottom line analysis, you need cash flows and a discount rate, but I just gave you the discount rate. We haven't figured out how do you calculate that discount rate. So that's a really big omission. And of course, by the end of these lectures, we'll be looking at how you figure out that discount rate for the asset investment decision. In fact, it's the last theory lecture of this series. So the next topic we went to was then the right-hand side of the balance sheet. This was in lecture 4 of this series. And we said, well, why is debt worth 400? And why is equity worth 600? And again, what two things do you think we needed to figure that out? Well, at this point, you're well trained, right? At this point, you're telling me cash flows and a discount rate. You know, the two things you need to value anything. However, for now, we assumed that we knew the discount rate for financial securities. So what we're going to get into today is, well, what should that discount rate be for financial securities? And at times, as we get into that today, it's going to look like sort of an investments class, and it would be very easy to go off in that tangent of investments. But the sole reason that we're doing the discount rate for financial securities really relates to our final topic, and that is the discount rate for the asset investment decision. And so the reason that we're doing this discount rate for financial securities is it turns out that it's highly related to the discount rate for the asset investment decision. In other words, you cannot understand this guy, the discount rate for the asset investment decision, unless you understand this guy, the discount rate for financial securities. And so that is why we're getting into the discount rate for financial securities today. So as a quick overview, the goal of this class is the theory and practice of the asset investment decision. Obviously, what you see online is going to be the theory. In my class, I get into cases to bridge theory with practice. And the two things that provide some bottom line analysis for the asset investment decision that you need are what? Cash flows and a discount rate when you do a net present value, the discount rate for the asset investment decision. But we were just provided that. You know, how do you calculate that? Well, the only reason I'm getting into the discount rate for financial securities because you need to understand this guy, the discount rate for financial securities, to understand that. Half of what you need to do a net present value, which is bottom line analysis for what is arguably the most important decision a firm makes, the discount rate, the asset investment decision. And then just a quick reminder, and that is, as I get into today's lecture and probably mostly today's lecture and to some degree next week's lecture, you're going to be thinking, well, where do you get that in real life? And so on and so forth. And I completely understand that. And my commitment to you is the kind of depth that we're going to get into is necessary to bridge theory with practice. In other words, when we start applying this stuff to the real world, and we start using judgment about, for example, well, you know, what kind of betas do we read or use, or risk-free rates, and you know, all this kind of stuff that we're going to get into, there's judgment involved. But unless you understand the depth or the theory that we're going to get into, you may as well be flipping a coin. And so, while there may be times where you're going to go, well, how do you get that in the real world, and when would you ever use this? My commitment or my guarantee is that we'll be drawing on the kind of depth that we get into to use judgment to bridge theory with practice. So with that in mind, let me start off with an agenda, and I'll begin with a general discussion, and then I'll provide you the rest of the agenda after this discussion. Okay? So remember, now we're jumping into the discount rate for financial securities. So here we have an example of a financial security. Okay? So suppose you pay $946 for something today, let's say it's a bond, and you get $45, say, every 6 months, and then $1,000 8 years from now, or 16 6-month periods from now. And when I say you get that, do I mean you're guaranteed to get that, or you have an expectation of getting this? You have an expectation, right? So here's my question for you. Does there exist a discount rate right now, at time zero, reflecting, if you will, the now by the 946 and the future with all of these expected cash flows and the risk inherent in those cash flows? Does there exist a discount rate that when I bring all of these guys back to time zero, I'm going to get an answer of $946, and therefore it's worth $946 today? That does, right? I mean, conceptually that exists. And if you calculated it, you get 5%. So therefore, when we're talking about discount rates, are we talking about something that reflects the now and the future? Or are we talking about something that reflects the past? Well, what do you see in the context of that diagram? Do you see historic cash flows, or do you see now and future cash flows? Now and future, right? So the discount rate, in theory, and what we want in practice, if we can get it, is basically about the now and the future. I mean, this is think of it this way, right? When it comes to, let's say you're thinking about buying stock, right? Now, do you buy stock today in a direct sense because of what the previous guy, whoever's selling you those shares, because of what he or she made on those shares? Or do you buy stock today based on what you hope to get out of it? Well, in a direct sense, you buy stock today, presumably, based on what you hope to get out of it. I mean, you're the one who's buying it, and presumably it's your returns that you care about. And so when you buy a stock today, it's basically a decision about the now and the future. The now is what you're paying for it today, and the future is what you hope to get out of it. Now, does that mean the past is irrelevant? Well, no, of course not. Past is definitely relevant. I mean, you'll use the past to provide you with a sense of your expectations of the future, but what you directly care about, as opposed to indirectly care about, is that the past or the future? The future. What you directly care about is the future. All right, so when it comes to valuing financial securities, what do investors appear to care about? Well, you invest $946 today. In a sense, are all these guys items that you get back? They are, right? When something gets given back to you, what do they call it? A return, right? So one of the things that you care about is return when it comes to financial securities. And let me ask you this. Is there any other characteristic about these cash flows or returns that is relevant to you? Well, what if they were incredibly high risk? Would they be worth more to you today or less to you today? Presumably less, right? And so the other characteristic that you care about in these cash flows is the risk, which is reflected in the discount rate. So what kind of relationship would you expect with risk and return? As investors take on more risk, would they require or have to be bribed, if you will, with higher returns or lower returns? Higher returns, right? And This is commonly known as the risk-return trade-off. And notice that statement, is that about the past or about the now and the future? Well, as we can see in the diagram, it's a statement about the now and the future. Why? Because this discount rate, what kind of data did we use? Did we use historic data or now and future data? Now and future data. And history's shown that, yeah, this relationship between risk and return exists. And so what we're going to do is we're going to begin by assuming, this is an assumption, that when investors value securities, they care about two things. One is risk, and the other is return. Now, does that mean we're assuming that investors dislike risk? I mean, let me do an experiment, okay? I can tell that this is clearly a really nice group of people watching this, okay? And so let's say I decide, you know what? I'm going to give each and every one of you $1,000. However, there's one condition. Either you have to invest it in a T-bill, or you have to take it to Las Vegas. Now, how many of you would invest in a T-bill? How many would take it to Las Vegas? All right, now, obviously, I can't see what's going on, but I'm guessing that some of you said, well, we'll invest in a T-bill, and some of you said, well, I'm going to take it to Vegas. I'm guessing most of you want to go to Vegas, but who knows? In any case, what that illustrates is that, is it fair to say that some people are risk lovers and some are risk haters or risk averse? Is that a fair statement? It is, right? So when we talk about assuming that when it comes to financial securities, investors care only about risk return, we are not assuming that investors like or dislike risk, because we know that some investors like risk and others dislike it. So what do we mean when we say we assume that investors care only about risk and return when it comes to financial securities? Well, what about this? Suppose I said to you, all right, well, here's this higher risk investment. Is there anyone that would be willing to take on a higher risk investment and not demand a higher required or expected return? Presumably not, right? In other words, all right, there may be risk lovers, there may be risk haters, but at least from a rational perspective, everyone's basically saying, hey, you know what? I'll take on more risk, but guess what? You're going to have to bribe me or incentivize me to take on that extra risk by a higher required or expected return. And by the way, for now, I'm using the term required return and expected return interchangeably, which is true under a particular circumstance, but we'll get to that later on, actually towards the end of this lecture. In any case, what we're assuming specifically is that investors are going to say, all right, you know what? What we want to do is we want to maximize our expected return for a given level of risk. Or another way of putting that is minimize the risk for a given level of expected return. And I say another way of putting that, to be honest with you, I'm being a little bit loose, but in the interest of simplicity. I like to think of it as analogous to, if you will, the price-quality dimension. So for example, here I have this pen, right? And suppose, so given that there's just this one single pen, suppose that suppose you see this on a shelf in a store, and it's priced for $1, this pen, and then the exact same pen is priced for $2 right next to it. So you have identical quality because you've got the exact same pen. Well, what would you do? Would you pay $1 or $2 for it? You pay 1, right? Why? Because your incentive is for a given quality level, to minimize price. Okay, another example. Suppose we have this great big paperclip, and that represents high quality. And this tiny little paperclip, and that represents low quality. Okay? And they both cost $1. What are you going to do? Which one are you going to buy? Well, you're going to buy the high quality for a given price. And I really do think that is a pretty good analogy, thinking of the price-quality dimension with stuff as risk and return is with financial securities. So basically, we're going to assume that when it comes to risk and return, hey, we want as much expected or required return as possible for a given level of risk. Or they're going to say, hey, for a given level of expected required return, we'd love to have a lot of risk or as little risk as possible. As little risk as possible, right? Now, on a different note, can you think of anything outside of the boundaries of risk and return that is not included as something that maybe investors care about? Because after all, we're just assuming that those are the only two things that investors care about when it comes to financial securities, risk and return. Well, some of you might say things like, well, what about inflation? Well, is inflation going to impact returns? And to the extent that it's unexpected risk? It might, right? And you could probably come up with a few other things. But what I'm thinking of is something that's basically called, in finance, degree of utility or degree of satisfaction. So in other words, you might go through analysis and figure out whether or not, from a risk and return perspective, it's a good or a bad time to replace your existing car with a new car. And that analysis might show you that, hey, this is not a good idea. Sorry, you're going to have to hold on to your old car for a while. But why might you buy it anyway? Well, maybe you like the new car smell. Maybe you can get dates easier that way, or whatever it is, right? And so that would be making a decision that falls outside of the boundaries of risk and return, and basically called degree of satisfaction or utility. And to give you a finance example, there are mutual funds called social funds. And what happens with these funds is they say, hey, we're going to invest in stuff that's only maybe environmentally friendly. So for example, if Exxon has just crashed into Alaska, well, we're not going to buy Exxon stock. And so here's my question for you. Suppose you have two mutual funds, right? This one right here, number 1, and this one right here, number 2. And they're both identical in risk and return. But this is the good guy fund. This is the environmentally friendly one, etc. And this just invests in whatever. My question to you is, are these going to be priced similarly to incorporate the notions of risk and return, or do you think that this will be priced higher to capture that degree of satisfaction? Well, it turns out that they're both going to be priced similarly. At least that's what research shows. In other words, when it comes to risk and return, that does a pretty good job of capturing what investors seem to care about with financial securities. And you could probably argue that makes sense. For example, how many of you, say, shop at Walmart? Well, if you do shop at Walmart, why do you shop at Walmart? Well, I would assume because for a given quality, it's low price. I mean, hey, check out this Walmart shirt, huh? Just kidding. Anyway, and yet, if we take it a little bit deeper, well, where does Walmart get most of their stuff from? From China, right? And then you could talk about, well, does that give me a a wonderful degree of satisfaction? Well, maybe it does, maybe it doesn't. But then when you add in the notion, I'm not trying to make this into a political thing, I'm just bringing up examples. Then when you add in the notion that they maybe use child labor or they have poor conditions or whatever, and I'm sure they have a lot of great conditions too. Again, this is just an example. But my point is you could make arguments where it decreases your satisfaction from or your degree of utility, but you still choose to shop at Walmart. Why? Because what drives your buying behavior primarily? Well, maybe not you personally, but on average, it tends to be maximizing that price-quality dimension. In other words, for given quality, on average, people are driven towards lower prices. And for given prices, on average, people are driven towards buying higher quality. And the same thing holds for risk and return with financial securities. So it's not a bad assumption that we're assuming that financial or that investors care primarily about financial securities. Okay, so there we have as risk for a given financial security, we're saying, all right, well then the required return by investors go up. So my question to you is, well, our goal is to figure out the discount rate for financial securities, right? That's our goal for this lecture. And again, why do we care about that? Is it highly related to the discount rate for the asset investment decision? It is, right? And why do we care about the discount rate for the asset investment decision? Well, because it's half of what you need to do a net present value, which is some bottom line analysis. You need cash flows and a discount rate, which is some bottom line analysis to what is arguably the most important decision a firm makes, and that is the asset investment decision. So getting back to this, risk goes up. Let's say IBM has 2 risk units, and so therefore the return required by IB investors is say 10%. Well, what does this 10% have to do with the discount rate that you would apply to IBM? Well, it turns out that they're one and the same. In other words, the discount rate for a financial security is its required return. And let me show you why. Suppose you give a bank $100 today, and you expect to get back $110 in 1 year. Well, given that, what is your expected or required return when you deposit the 100 with the bank? Well, 10%, right? $100 at 10% grows into 110. Well, let's look at this a slightly different way. Is it true that the $100 at time 0 is equivalent to 110 at time 1, given that 10%? That's true, right? So if I were going to bring this 110 back to time 0, then what discount rate would I apply? Well, I'd apply 10%. And so therefore, the discount rate for the financial security is its required or expected return. So if we put this in perspective, what that means is here we have IBM. We've assumed that investors care only about 2 things, risk and expected return. And this expected return is the discount rate for the financial security. And that's our goal, to figure out the discount rate for financial securities. So what's our approach going to be? Well, what we're going to do is we're going to quantify this risk. And we're going to quantify this expected return. However, is it kind of vague to say, well, the higher the risk, the higher the required return? It is, right? That's a little vague. We need to be more specific than that. We need a mathematical model or a formula, if you will, that links risk with return. So, for example, if IBM has a risk of, say, X, maybe IBM has X risk units, then we need some kind of formula or mathematical model that says, all right, well, in that case, IBM's discount rate is Y%. And I'm making up this these risk units. I'm just making that up. We'll get to specifically how you quantify it. But for example, if IBM has 5 risk units, maybe we develop a formula that says, all right, well therefore IBM's expected or required return is say 10%. And if that's true, then what would IBM's discount rate be? It would be 10%. Or in the context of these numbers right here, X and Y, it would be Y%. And that's our goal, to figure out the discount rate for financial securities. Now, by the way, not all risk is priced. And what we care about is price risk. Now, what do you think I mean by price risk? Well, when we get back to the sentence, well, yeah, I'll take on more risk, but it's going to cost you. I'm going to require higher returns. Is that like a pricing sentence? It is, right? I mean, it's similar to this. All right, well, I'll buy this pen, and it's $1, and maybe I'll buy another pen, but it's going to cost me. It's going to cost me maybe another $1.50 or whatever it is. Okay, every time I buy another pen, I'm going to have to pay more money. And so it's the same thing here with financial securities. I'll take on more risk, but it's going to cost you. It's going to cost you in terms of higher required or expected returns. And so what I mean by price risk is risk that applies to that sentence. For more risk, we require more returns. And we're going to find out that there's some risk inherent in any single security, like say IBM stock, that you can get rid of for free. And if anyone can get rid of risk for free, is it going to be part of that pricing sentence? For more risk, we require more return? In other words, if for some reason anybody could get these pens for free, anyone, and I went onto the street and I tried to sell them for $1, would anybody be willing to pay me $1 for this pen? No. Because guess what? They can get it for free. And it's the same thing right here with financial securities. So we'll find out there's some risk inherent in individual financial securities that if you choose to, you can get rid of for free, and therefore is not part of that sentence. For more risk, we require more return. So with that in mind, let me get into the rest of the agenda. And we're going to start in a world of just one single security, and we're going to quantify return, and we're going to quantify risk. And then we're going to move to a portfolio of securities. Now, what do I mean by a portfolio? Basically, more than one financial security. So right here with a single security, maybe I have all my money, everything in IBM stock. But here, maybe I have half in IBM stock and half in Home Depot stock. Now I have a portfolio. Or maybe I have it in 100 different stocks or bonds or whatever. Now I have a portfolio. And so we're going to move to a portfolio when we quantify expected return and quantify risk. And the reason we're moving from a single security to a portfolio is we're going to find out that when you add a single security to a portfolio, that is when you can get rid of some risk in that single security for free, in contrast to holding just that single security. So that's when we get into, well, how much risk does a single security add to a portfolio? And then finally, we'll develop a formula or an equation or whatever that links risk with required return. Okay, so let's move to the world of a single security. In other words, all I own is just say one stock. All I own is IBM stock, okay? And my goal is to get expected return. Well, I'm going to start off with a game, and for this game I need a $20 bill. Any volunteers? Well, when I'm in class, usually people aren't reluctant to give up $20, but I just happen to have a $20 bill right about here. Okay, $20. And here's the game. What I'm going to do is I'm going to fold up this $20 bill, okay, into a tiny little piece. and I'm going to put it in one of my hands. Okay? Now, I'm going to put it behind my back, and you're not going to know which hand it's in, and then you're going to pick a hand. So here's my question. What is your expected cash flow when you pick a hand? Well, some of you might say $0 because you think you're not going to get lucky and pick the hand without the $20 bill. Some of you are going to pick $20, and some of you are probably going to say $10. Well, you want to see which one you had? Which one did you pick? Well, if you picked this one, sorry. If you picked this one, well, hey, come get it, right? In any case, here's my question. Was there any way that you could expect, using the word expect just from the English language, to get $10? There was no way, right? I mean, either you're going to get 0 or you're going to get 20. And yet some of you probably said, well, my expected cash flow, what I'm calling the event is what I'm calling cash flow, either cash flow of 0 or cash flow of 20. And some of you said $10. Why? Because what you're basically doing is using the word expect more from a technical viewpoint. In fact, you're doing what's called applying a mathematical operator, or the expectations operator. And what is that operator? Well, basically, what was the probability of getting 0? 50%, right? And the probability of getting 20 was 50%. And so the process of taking the probability and multiplying it by whatever the event is, which in this case was cash, and then adding them up over the total range of possibilities, in this case $10, that's what's called applying the expectations operator. Now, the expectations operator is nothing more than a mathematical operator. What are some other examples of mathematical operators? Well, you want a clue? How about plus? Is plus a mathematical operator? It is, right? Other examples? Well, minus, divided by, multiply, etc. Okay, those are all examples of mathematical operators. And the process of taking the probabilities and multiplying and then adding them up over that range, in this example, we're applying the expectations operator to this event, which I'm just calling cash. The event was either $20 or $0. And so what does the expectations operator do? Well, it basically has the effect, if you will, of crushing a range of possible outcomes. In this case, there were just two possible outcomes, $20 or $0, and crushing them, if you will, into one expected number. Now, my guess is that all of you are highly familiar with this. I mean, you probably had it in middle school or high school or whatever, right? And yet, later, when I make the event more complicated, so applying the expectation operator is going to be identical to this example, but when I change the event to make it more complicated, some of you are going to forget how to apply the expectations operator. And I want to be wrong, right? I'm saying that because I'm challenging that not to be the case. But just remember the simplicity of applying the expectations operator. And like I said, later on, all we're going to do is make the event a little bit more complicated. All right, so that's the expectations operator. But our goal was to get expected return. So now the event is going to change to return. Well, suppose IBM in a boom gets 20% return, and in a recession 10% return. And maybe we know the probability of a boom and a probability of a recession. So with that information, could I calculate IBM's expected return? I could, right? I would apply the expectations operator to what? What is the new event now? The new event is their return, right? So if we look at it like this, there was a 60% probability of a boom associated with this 20%, a 40% probability of a recession associated with this 10%, multiply them and add them up over the range, and you get 16%. So in other words, IBM's expected return is 16%. And so we've achieved at least part of our goal. We figured out the expected return for a single security. By the way, you might see in your books some standard notation. If you put a bar over something, that means expected. If you put a squiggle, that means there's some uncertainty, right? Because you don't know if you're going to get the 10% or the 20%. Or it could be realized once it's happened, you got the 20 or you got the 10. Okay, so that's just some standard notation you might see, and that I'll use some of this. Well, let's move on to risk. So we've done expected return for a single security. Let's look about the risk. Now, when you think of risk, do you think about the expected or the unexpected? Well, I'm guessing you think about the unexpected. So, for example, realistically speaking, is there any risk that the sun will not rise tomorrow? Realistically, I mean, we could get into, I guess, philosophical discussions, but the fact is, every single day of your life, is it fair to say that so far the sun has risen, without exception? It has, right? So you expect the sun to rise. Fully expect that not only you do expect it to rise, but it does rise, and so there's no risk to think of about wondering whether the sun will rise or not. But what about whether it's going to rain tomorrow? Is it possible that it might rain or might not rain? It could be either one, right? So there's more room for unexpected stuff. And so risk, I'm going to assume it's intuitive to you that risk is about the unexpected. Well, our goal is to quantify risk, right? So how do we quantify what is unexpected? I mean, what would you do? How would you develop a formula that says, all right, well, this is how much is unexpected? Well, let's take the IBM example. What was the expected return of IBM? Do you remember? It was 16%, right? Well, what if we actually got 20? So we got 20, we expected 16. How much of that is unexpected? 4, right? So in other words, a way to quantify the unexpected is simply to take the difference between what you expected and what you actually got. Look at it from this perspective. Here we have security A. Suppose the expected return of security A was, say, 8%. So this is what was expected. But suppose what actually happened with security A is that every single time it was always 8%. So in other words, nothing unexpected ever happened. So if we were going to try to come up with a formula that measured risk and we applied it to security A, we would want our answer to be what? 0, right? Because A has no risk. Now what about this guy right here? This is IBM. Okay, here's our expected return of IBM. And we said, well, there was a 60% probability of a boom, in which case it realized 20%. Or 40% probability of recession, in which case it would realize 10%. Does IBM have risk? Does unexpected stuff happen? It does, right? So when it comes to these two securities, which one is riskier, A or IBM? IBM, right? So if we developed a formula for risk, would we want an answer of 0 if we applied it to IBM? We wouldn't, right? Because it has some risk. But on the other hand, we want an answer of 0 for A because it has no risk. So let's try to develop a formula that measures risk. We'll use IBM. So we've said that risk is about the expected or the unexpected. The unexpected, right? Well, how much is unexpected if this 20% is what is realized? Well, it would be 4%, right? We get 20, we expected 16, so 4% would be unexpected. What about if we get this 10%? How much of that is unexpected? We expected 16, we got 10. You might say 6% is unexpected. But if we're going to have a +4 here, then we better have a what here to be consistent? We better have a -6, right? Because, by the way, is risk just about sad face, unexpected bad news, or is it about both happy and sad face? It's about both, right? But both of these, whether it's you getting more than expected or less than expected, is still about the unexpected, and therefore a reflection of risk. So here's my question. What probability is associated with this 4%? Well, we had a 60% probability of realizing 20, and therefore 60% probability of having, if you will, a 4% happy face. And what about this -6? What probability is associated with that? Well, 40%, right? So in other words, we have a 4% surprise, this guy, that's associated with that probability, and a -6 disappointment that's associated with that probability. So we've said risk is about the unexpected. Here we've captured the +4 and the -6, unexpected stuff. What could I apply to these two numbers, if you will, to crush it into one single unexpected or risk event number? Well, what kind of operator did we apply earlier when I had the $20 in one hand and 0 in the other hand? Applied the expectations operator, right? And could I do the same thing right here? I could, right? So if we look at it right here, now my event is unexpected return, because we said that risk is about the expected or the unexpected. The unexpected. So I have my +4 and my -6. If I apply the expectations operator, I multiply them and add them up over the range, and I get an answer of 0. Well, is this risk measure working? Did IBM have 0 risk? It didn't, right? I mean, IBM certainly had risk, so there's something going wrong here. What's going wrong? Why is this not working? Well, basically, this plus is canceling out with this minus. So in other words, we have some kind of sign problem. I mean, the concept is working really well. We want the flavor of the unexpected, but we've got this. We don't want the canceling to happen. So how could we change this event that's still a function of the unexpected, and therefore still a function of risk, but what could we do to this such that we wouldn't have this sign problem, or we wouldn't have this cancellation going on? Well, there's a couple different things we could do. Either we could say, all right, well, let's make the event the absolute value of the unexpected. So this would be a +4, and we'd force that into a +6. And sure, we could go ahead and do that, and the formula would work. What's another thing we could do? Well, what if we squared this? So +4 times +4, that's still a plus number. -6 times -6, what does that turn into? When you multiply minus by minus, what do you get? You get a plus, right? So we could square this, and that would also work. In both cases, we'd get rid of the sign problem. And what I'm going to do is I'm going to go with what has become mainstream, with the various formulas and so on and so forth that the real world uses, and I'm going to square it. So here's our old event. Our new event, I'm just going to square these numbers so I don't have the sign problem. So what probability is associated with that 0.0016? 60%, right? What probability is associated with this 0.0036? 40%, right? So what could I apply to these two numbers, if you will, to crush them into one single, quote-unquote, expected number? Could I apply the expectations operator? I could, right? So when I take this 60% and multiply it by that, I get that. Take this 40%, multiply it by that, and I get that. I add them up and I get 0.0024. And that is what is called the variance of IBM. That's just the name of the formula. They could have called it George. They could have called it whatever they wanted to, but basically squaring what is unexpected and applying the expectations operator is called the variance. And by the way, if you took the square root of that, of the variance, it's called the standard deviation. I'm going to use different notation. I'm going to use VAR and SD just to keep it simple. So essentially, if we go back and we look at IBM, the question is, well, is this risk measure working? In other words, if these gaps were bigger, if I had a bigger unexpected amount, would I get a bigger answer here or a smaller answer? I'd get a bigger answer, right? And if we applied this to security A, so for example, the unexpected was always 0, which would mean this number would be 0 and this number would be 0, and therefore our answer would be what? 0, right? And so, is this risk measure working? It is, right? That the bigger the risk, the bigger the number I'm going to have here. And the smaller the risk, the smaller the number I'll have here. And when the risk is 0, because nothing unexpected ever happens, then my answer here will be what? 0. So it's working. So you should not be memorizing that formula. You should really understand it. In fact, you should be able to teach it to me if I wanted you to. How? Well, we began with the logic. Is risk about the expected or the unexpected? Well, it's about the unexpected, right? Okay, great. So how do you measure the unexpected? Well, it's the difference between what actually happens and what was expected to happen. All right, great. Well, we'll just apply the expectations operator to that. Well, except if we did that, we'd have a sign problem. So we'll change the unexpected to a function of the unexpected, and therefore still a reflection of risk. We'll square it so we don't have a sign problem. So now the new event is that the square of this 4% and the square of the minus 6%, but they still have these probabilities associated with it. And so that's what we apply the expectations operator to. So that should be something that you understand and not memorize. So what we're going to do now, that was all single security. Our goal was to quantify risk and return in the world of just a single security. So all we held was just IBM and nothing else as an example. And now we're going to move to a portfolio. And again, what do I mean by portfolio? More than one financial security. Could be 1 million financial securities, 100, could be 2, but just more than one. So we'll begin with portfolio expected return. Suppose I had half my money in IBM, which had an expected return of 16%, and half my money in Home Depot, which has an expected return of, say, 10%. So half my money is expected to make 16, half my money is expected to make 10. What's my portfolio expected return? Well, it's just a weighted average, right? In this example, it would be 13%. So half my money at 16, half my money at 10, and I get 13%. So, question is, did anything magical happen? I mean, from our perspective, our goal for a given level of risk is to do what with returns? Maximize or minimize? Presumably maximize, right? So when we moved from a single security to a portfolio, did we magically boost our returns somehow, or was it just a fair way to calculate portfolio expected returns? Just a fair way, right? It was just a simple weighted average. Well, let's see if the same thing is true of portfolio risk. And as we get into portfolio risk, what I'd like to do is I'd like to begin with the intuition, and then we'll get into the mathematics. So imagine that we have two securities, maybe two stocks, right? And I'm just not creative enough to think of names, so we'll just call it Security A has an expected return of 20% and has some risk. Okay? And let's say security B has an expected return of 10%, and that also has some risk. And then let's say I have half my money in each. Well, if I have half my money in each, what's the portfolio expected return? So I have half my money expected to make 20, half my money expected to make 10. So my portfolio expected return would be 15. Now, by the way, suppose let's see, let me get some exhibits here. Let's say this is George, and here's a blue one. Let's say this is Mary. Okay, so purple investor, blue investor, and there's me. Okay. Now let's say the purple investor, this is the guy or whoever that has 20%. This is security A, and this is B for blue, the 10%, right? And then I have half my money in each. Now, if somehow I said, and let's say this is all they had, this guy, the purple, only has security A, nothing else. And this guy only has security B and nothing else, but I have half my money each. Now, both of these are taking on risk, right? Now, suppose I told you, well, in my case, I have a bit of each. So I just get a fair return, that's 15%, but I got rid of all my risk. If there was some way I had zero risk, then who would you say, at least intuitively, got the best deal? Well, presumably me, right? Because from a return perspective, I just got what was fair, an average of these two. But these two guys, they took on risk, and I got rid of all risk. Well, let me make up an example, and it's extreme, but it's just to illustrate a point where this is what actually happens. Suppose security A and security B are perfectly negatively correlated. What does that mean, by the way? If A went up by 2%, then what would B do? It would go down by the exact same amount, 2%. And in case you're interested, they would say the correlation between A and B is -1. So let's take a look at what happens. So here's the expected return of A, 20%, the expected return of B, 10%, and here's my expected portfolio return of 15%. Now suppose coincidentally the actual return of A and B were 20 and 10. If that were true, then what would be the actual portfolio return? 15, right? Okay, so now suppose A's return is 2% higher than expected. So this is 22. Then what would be true of B's return? Well, it'd be 2% lower than expected, right? So I have, as a portfolio, I have half my money making 22, half my money making 8. So what's my actual portfolio return? It would be 15%, right? All right. Suppose A now drops all the way down to, say, 12%. So what is that? That's 8% less than expected. Then what would happen to B? Well, B would be 8% higher than expected. So in other words, 18. So I have half my money making 18, half my money making 12. What would be my actual portfolio return? Be 15%, right? Suppose A's return is now 17%. Okay, so that's 3% lower than expected. Then what would B be? Well, 3% higher than expected. So I have half my money at 17, half at 13. What's my actual portfolio return? Again, 15%. So what do you notice about the portfolio? Does anything unexpected ever happen with the portfolio? It doesn't, right? Notice these actual returns are always equal to the expected returns. And so if the unexpected is always 0, then what can you say about the risk of the portfolio? That it has risk or has no risk? It has no risk. Its risk would be 0. It would be what's called risk-free. So if we put this in perspective, you know, we began with two securities. Okay, we had the purple investor and the blue investor, and this guy had 20 and some risk, and this guy had 10 and some risk, or woman, or whatever. Okay, and a weighted average with me, I had the portfolio, was 15%, and that was just fair. But for me, I got rid of the risk. So again, who had the best deal? Well, I had the best deal, right? You know, if the goal is to maximize your returns for a given level of risk, then I had the best deal. I had no risk for just what was a fair way to calculate returns. And what is that concept called when you get rid of risk just because you choose to hold something as part of a portfolio as opposed to having all of your eggs in one basket? It's called diversification, which, by the way, that concept won the Nobel Prize. Let's put it in a different way, okay? It's what I call umbrellas and ice cream, okay? Is weather a type of risk? It is, right? I mean, we have unexpected weather all the time. In fact, do prices go up and down depending upon weather? I mean, if they have a freeze in Colombia, what happens to the price of coffee? Goes up, right? And I should say in particular, especially if it's an unexpected freeze. So imagine that we have somebody who holds just umbrella stock, maybe that's the purple guy, and somebody who holds just ice cream stock, and then there's me, I hold both, okay? So let's say it's an unexpectedly rainy summer. What's going to happen to the umbrella stock? Probably go up, right? Go up unexpectedly. What's going to happen to the ice cream stock? Go down unexpectedly. Well, what if it is a unexpectedly hot, dry summer? It would be the other way around, right? So in other words, depending upon the weather, these guys are going to be pretty volatile. On the other hand, if I have both, okay, then is happy face here going to be offset by sad face there? It is, right? And vice versa also. So in other words, because I have both umbrella stock and ice cream stock, there's some degree of diversification going on. I'm able to get rid of some risk because I choose to hold stock as part of a well-diversified portfolio. So here's my question. As I add more securities to a portfolio, do you think there's more opportunity or less opportunity to diversify away risk? Well, probably more opportunity, right? Because there's more risk interaction going on. Let me show you an example. Okay, suppose, and I'm just making this up. Give me a second here. Suppose I have IBM, and suppose when I hold IBM, okay, so here's IBM, and suppose when I hold IBM, and that's all I hold, it has 10 risk units. And again, I'm making up the I'm making up this what I'm calling 10 risk units. Okay, and then I have a maybe Home Depot. So here I have Home Depot, and I add IBM right here to Home Depot. Okay, so according to this concept of diversification, would IBM add the whole 10 risk units to this portfolio or something less? Something less, right? Because presumably there's some risk interaction going on and some of this 10 is diversified away. So maybe IBM, you know, maybe it adds, I'll just make this up, you know, 8 risk units at this point. So now let me give you another example, okay? So now the market is going to be Home Depot, and it's going to be Apple, and it's just going to be, you know, maybe, you know, 30, you know, a total of 30 securities, right? Home Depot, Apple, Coke, etc., etc. And now I add IBM. So I'm adding IBM, okay? So now, before, when you added IBM to just Home Depot, yeah, we got rid of some risk, but we added 8 risk units. Now, do you think there's more opportunity, if you will, for this risk interaction, and therefore more opportunity to diversify away risk, or less opportunity? Well, presumably more opportunity. In which case, when we see how much risk IBM added to this portfolio, would it be more than these 8 risk units, or probably less? It'd be less, right? So maybe, and again, I'll make this up, maybe IBM adds, say, 6 or say 4 risk units. Okay. So what's the maximum amount of risk interaction that could possibly exist if I added IBM to what? Well, in theory, if I added IBM to all financial securities in the universe, in other words, an infinite number of financial securities. So, for example, okay, so maybe, maybe we add IBM to an infinite number of financial securities. But even when you add IBM to an infinite number of financial securities, I suppose I should say infinity minus 1, is IBM still going to contribute some risk, or does it magically become risk-free? Yeah, it'll still contribute some risk, right? And so maybe it adds 3 risk units. Okay? And so basically, what we do is that, and what do you call an infinite number of financial securities? The market, right? So we assume that the market is a well-diversified portfolio. As I mentioned, the market is all financial securities in the entire universe. And even when you add IBM to a well-diversified portfolio, is there still going to be some risk you're stuck with? There is, right? IBM's still going to have some risk. You're not going to get rid of everything. And that's what we call IBM's non-diversifiable risk. The amount of risk that IBM adds or contributes to a well-diversified portfolio is its non-diversifiable risk. So you can get rid of this stuff. So in our example, holding IBM just by itself, I made up 10 risk units. And by the time we added it to the whole market, we still contributed 3 risk units, and we were able to get rid of 7 risk units, which would be the equivalent of the diversifiable risk. Again, I'm just making up this notion of risk units. We'll be more specific later on. So as I mentioned, even when you hold a well-diversified portfolio, you're still contributing some risk, and that would be IBM's non-diversifiable risk. So IBM's non-diversifiable risk is the amount of risk. It's really important for you to get this down, because we're going to be building on this concept. It's the amount of risk that it adds, or if you will, contributes to a well-diversified portfolio. Maybe another way of illustrating this is if all you hold is just maybe 2 securities right here, and then you add IBM, well, you're going to be adding all this risk. Now maybe you're holding 20 securities, and you add IBM, well, you add this much risk. You add the whole market, and IBM's still going to contribute some risk. Okay, that's the non-diversifiable risk. By the way, books and textbooks are going to have other names for this. They're going to call diversifiable risk unsystematic and unique, non-diversifiable, systematic, market. I don't like those names, to be honest with you, especially this market risk, because market risk is not risk of the market. It's kind of confusing. So I'm going to be using these terms diversifiable and non-diversifiable. Okay, so inherent in any single security, there's some risk that when you choose to add it to a portfolio, you're going to be stuck with. So it's not diversifiable. It's still going to add or contribute risk to that portfolio. But there's some risk that you can get rid of. If you want a flavor for what I mean by this stuff, non-diversifiable thing would be factors that affect or impact a large number of assets. For example, inflation and interest rates and so on and so forth. And then risk factors that affect just limited number of assets, maybe particular labor strike or part shortages and so on and so forth. So here's my question. When it comes to a single security, is it fair to say that risk is either diversifiable or it's not diversifiable? Can it be both at the same time? I want to get into a deep philosophical discussion here. Can a door be open and shut at the same time? Can't, right? So what I'm going to do is I'm going to call total risk as the sum of these two guys. And I'm about to ask you a question, but I want to make one quick assumption just to get this across. Let's say that when it comes to transaction costs, it's no more costly to hold a single a single stock, than it is to have a whole portfolio. So for example, if I went on E-Trade and I bought $100,000 worth of IBM, what would I pay for a commission? I don't know, $7, something like that. But if I bought $100,000 worth of, say, the Wilshire Index or the S&P 500 or whatever, how much would I pay in commissions? Maybe $7, $10, whatever. So I'm ignoring, transaction costs. So here's the main point. When it comes to that question, this is the pricing question, right? For more risk, we require more return. What I want to know is, well, for which risk factor is that true? Should I say for more diversifiable risk, we require more return? Should I say for more non-diversifiable risk, we require more return? Or should I say for more total risk, we require more return? What do you think? Well, let me ask you this. Can you get rid of this guy for free? Is everybody free to have a portfolio instead of putting all their eggs in one basket? They are, right? There's no law that says you have to put all your stuff in one basket. And we made the assumption earlier that we assumed that investors cared about risk and return. In particular, we assumed that when it came to pricing financial securities, that they would reflect the concept of, all right, well, for given required or expected returns, I want to what? Maximize or minimize my risk? Minimize, right? And so basically, if this risk, diversifiable risk, can be gotten rid of for free, is anybody going to get away with charging for that risk? They're not, right? And therefore, should it be part of this pricing sentence? For more risk, that, by the way, I can get rid of for free, I require more return. Should it be part of it? It shouldn't, right? And so if diversifiable risk is not part of this pricing sentence, is total risk part of that pricing sentence? It's not, right? Because we defined as total as being the sum of these two guys. So now what we know is, when it comes to that pricing sentence, for more non-diversifiable risk, we require more return. I'll talk a little bit more about that in a second. But let me give you another sort of story. I live in a neighborhood, about 1,500 households or whatever. And if you're like me, well, we get these coupons in the mail all the time, including pizza coupons. So imagine that I get a pizza coupon that says $5 off a large pizza. Okay? And let's say a large pizza costs, say, $20. All right? But I've got this coupon that says, excuse me, got to make the coupon here a second. I got a coupon that says, hey, $5 off. Minus $5. All right, there's my coupon. $5 off. So the pizza guy comes to the door and brings me the large pizza. And what do I end up paying? Do I end up paying this whole 20 or do I in the end up paying 15? I'm ignoring the tip. I pay 15, right? 20, and then I give them the coupon. So my question to you is, could I take the pizza next door? Let's assume they were hungry, wanted a pizza. Could I take it next door and sell it to them for 20? Would it be rational of them to buy it from me for 20, even if they trusted me not to poison it or whatever? It wouldn't, right? And why is that? Because they also have the coupon. In other words, they also have a way to knock off $5 from the price. And that's the analogy with this diversifiable risk. This is like the $5 coupon. But in the end, do you still pay something for that pizza? You do, right? And that's the non-diversifiable risk. And so risk that is quote-unquote priced, in other words, risk that is part of that pricing sentence, for more risk, we require more return, is the non-diversifiable risk. So the more risk that IBM contributes to a well-diversified portfolio, the greater the required return of IBM. So if we put in this perspective, now our goal in particular is to quantify what kind of risk for IBM. Their diversifiable risk or their non-diversifiable risk? Non-diversifiable, right? And then we'll create a model or a mathematical equation that says, hey, the more the non-diversifiable risk of IBM, the more its required return. And if that required return, as an example, ended up being 10%, then what would IBM's discount rate be? It would be 10%. And that was our goal, to figure out the discount rate for financial securities. And again, why do we care about that? Because it's highly related to what? The discount rate for the asset investment decision. And why do we care about the discount rate for the asset investment decision? Because it's half of what you need for a net present value analysis, which is sort of a bottom line analysis for the asset investment decision, which is arguably the most important decision a firm makes. And that's our goal in this class, the theory and the practice of the asset investment decision. Okay, so we've done hopefully the intuition, hopefully that it makes sense to you as far as this concept called diversification. And so now we need to get into the mathematics. And again, as I mentioned, the reason we're going to have to get into the depth we get into is because it's relevant to bridging theory with practice, as we'll see when we do cases if you're in my class. So, as I already mentioned, what is IBM's non-diversifiable risk as an example? Well, as you can see right there, it's the amount of risk that it adds or contributes to a well-diversified portfolio. But hopefully that's not just a definition. Hopefully that makes sense to you at this point as to why that's the case. So, and that's our goal. We want to quantify the non-diversifiable risk because that's the relevant risk when it comes to what in particular? That pricing sentence, right? For more non-diversifiable risk, we require more return, and that return is the discount rate, which is what we're trying to figure out, the discount rate for financial securities. So here's what we're going to do. Basically, we're going to take a look at a portfolio, and we're going to say, well, when we have a portfolio, how much is the total risk of that portfolio? And then what we're hoping is that, well, if we can look at the whole portfolio and see how much of it represents the total risk, or how to quantify the total risk, maybe, and we'll find out we can, maybe we can identify, well, how much is any given security, how much is, say, IBM contributing to the risk of that portfolio? And if the risk of that portfolio is well diversified, then that would be IBM's non-diversifiable risk. So that's what we're going to do. We're going to look at total portfolio. Can we somehow identify what total portfolio risk is? And then by looking at total portfolio risk, can we look at segments of it and say, hey, this is how much IBM is contributing? And if that portfolio is well diversified, then that is IBM's non-diversifiable risk. And that's what we're trying to quantify right now. Just a quick reminder on notation, by the way, since I'll be using this stuff. As I mentioned earlier, a bar over thing, that's the expected return, and that's unexpected. So when we had the IBM example earlier, hey, I actually get 20, I expected 16. So the difference between those two would have been 4%. So speaking of single risk, remind me, back in the world of just one single security, what was the name of the formula that we came up with that quantified risk? It was the variance, right? And how did we get variance? Well, we applied the expectations operator to this unexpected squared. Now, if that doesn't make sense, then go back to the part where we looked at risk of a single security and just remind yourself of that, because we're going to be building on that. So the expectations operator applied to this unexpected squared. So if IBM actually got 20, you expected 16, how much of that was unexpected? The plus 4, right? But then we squared that. Notice, by the way, that's the same thing as the unexpected, the plus 4, times the unexpected, the plus 4. So here's my question. When we think about the risk of a portfolio, well, yeah, we've got the risk of a stock with itself, but do we also need to consider the risk interaction that happens between, say, IBM and Home Depot? We do, right? And would it make sense that would be part of total portfolio risk to also include the risk interaction, if you will, that exists between securities? It would, right? So basically, we need to capture that interaction. And I will go through an example, but the name that we give to the formula that does capture that risk interaction is called covariance. So we'll get to how you calculate covariance in a minute, and hopefully I'll get across the intuition of why covariance captures risk interaction. But would it make sense that when we are looking at total portfolio risk, that it would include both variance and covariance terms? Well, presumably it would include both of those. As a quick preview, for example, if we had 3 securities, A, B, and C, well, A with itself is going to have a variance, but then there's going to be some risk interaction, what we call covariance between A and B, and covariance between A and C, and so on and so forth. So when it comes to total portfolio risk, we're going to find out that it's going to include these terms. And again, just remind me, why are we looking at total portfolio risk? Well, what we're trying to do is, well, if we can understand total portfolio risk, maybe we can see how much risk any single security, like say IBM, contributes to that portfolio. And if that portfolio is well diversified, then the amount of risk that IBM, for example, contributes or adds to a well diversified portfolio, that is its what? It's non-diversifiable risk. And is that the relevant risk, or the risk that is priced? For more non-diversifiable risk, we require more return? It is, right? So that's what we're trying to do, quantify non-diversifiable risk right now. So we're beginning by looking at, well, what factors go into total portfolio risk? So let's talk a little bit about this covariance thing a minute. Now recall, variance was the event was the unexpected of, say, IBM with itself times the unexpected, or the unexpected squared. Well, covariance is basically very similar if you look at the formulas, except instead of the unexpected of IBM times the unexpected of IBM, it's the unexpected of, say, security A times the unexpected of security B. For example, remember that umbrella and ice cream example? Okay, so for a given risk, let's say this is umbrella, for an unexpectedly, say, rainy summer, would this have been happy face or sad face? Happy face, right? So maybe that was plus 2%. And for that same unexpectedly hot, dry summer, no, what did I say? Rainy, sorry. Unexpectedly rainy summer, for ice cream, happy face or sad face? Sad face, right? Maybe this was minus 3%. So plus 2 times minus 3, that would be the event. And is there a probability associated with that unexpectedly rainy summer? There is, right? So in other words, this event, that's meant to capture the risk interaction. And I'll do an actual example a little bit later just to go through the mechanics. But in any case, the covariance between any two securities, and that's what a covariance applies to, say between Home Depot and Apple, and between Home Depot and IBM, and between Home Depot and Coke, and so on and so forth, is basically the expectations operator applied to where our event is the unexpected in one of the securities times the unexpected in the other security. So, can covariance between A and B, can this event be negative? It can, right? So for example, with the umbrella and ice cream, maybe this went up by 2% and this went down by 1%. So it'd be a plus times a minus, and it would be negative. And so it's really easy to teach that the risk interaction is risk reducing when you have a negative number, because people intuitively think of 0 as the benchmark. But is 0 really the benchmark? Let's get back to the purple investor and the blue investor, right? So imagine the purple investor owns a security that has, say, 8 risk units held just by itself, and that's that this person has just this security, so that they're no portfolio. So 8 risk units here, and maybe this person has 4 risk units. So together, even though they're 2 separate people, you could say the sum is 12 risk units. Well, that's the real benchmark. If as a portfolio you hold them both, and now you have 10 risk units, the real benchmark is that 12, not 0. So in other words, it is possible that even when the covariance is positive, even when this might be plus 1% and this might be plus 2%, so even when the covariance is positive, is it still less risk than if you take the sum of 2 individuals holding just those stocks and are not diversified? It is, right? And so covariance does not have to be negative to be risk reducing. In fact, the only time where there's no diversification going on is if 2 securities are perfectly positively correlated. In other words, if I hold this stock right here, it goes up by 1%, then this stock right here also goes up by 1%. Or if it goes down by 2%, this also goes down by 2%. So if they go up and down exactly in tandem, well, realistically, how would that happen? Let's say I have 100 shares of IBM in this hand. What would I add to it in this hand where they would always go up and down exactly in tandem? More shares of IBM, right? So maybe I have 100 shares of IBM in this hand, and I add 500 shares more of IBM in this hand. Has any diversification gone on? No. So they go up and down exactly in tandem. But even when they go up and down together, but at different rates, now is there some kind of risk interaction going on? There is, right? Which means less risk than if you were not diversified. If all you held was just one stock, and another person, all they held was one stock, and you added those 2 risk units together. So let me go through a covariance example, and maybe that will help you understand the concept of covariance. And again, I'm only going to go through this example just because it's relevant to what kind of risk. We're going to find out that it's relevant to figuring out total portfolio risk. And again, why do we care about total portfolio risk? Well, we're going to try to find out, well, if we have total portfolio risk, how much is any single security contributing to that risk? So how much risk is, say, IBM contributing to a portfolio? And if that portfolio is well diversified, then that would be IBM's what? Non-diversifiable risk. But for now, we'll just go through how to calculate covariance. So let's say 60% chance of boom, 40% recession. Let's say A's return in a boom and recession of 20 and 10. By the way, with these 4 pieces of information, can I calculate A's expected return? I can, right? Now, if you can't do that, then you need to go back to the world of a single security earlier on the agenda and calculating expected return. I mean, I'm happy to do it for you, but it's for your own benefit that you've figured out on your own. And then right here, with this information, 60 and 40, and with B, 8 and 14, could I calculate B's expected return? I could, right? And the question is, what is the covariance between A and B? So on your own, convince yourself that the expected return of A is 16 and of B is 10.4. So here we have the probabilities. Here we have the actual returns of A with these boom and recession or whatever, and with B. So here's the unexpected in A. Remember, A actually gets 20, but expected to get 16. Well, how much of that is unexpected? Well, the difference between what they actually get, 20, and what was it? They expected to get 16, so plus 4, right? So this, what you actually get minus what you're expected to get, is 20 minus 16, or plus 4. Well, when there's a boom, and A has unexpectedly 4% happy face, well, B has unexpectedly 2.4% sad face. Why? Because in a boom, I guess this is a counter-cyclical stock or whatever, B got 8, but they're expecting 10.4, so they got less than expected, or 2.4 less. So what's our, what we call event? Remember earlier on, I called the cash flow was either $20 or $0. That was the event. Well, now the event is multiplying these two numbers, the unexpected in A times the unexpected in B for the boom. And same thing for the recession. So my question is, well, what could I do to the event now? Well, what could I do to get these two numbers and crush them into one single, if you will, expected number? Could I apply a smooth operator? I mean a mathematical operator? I could, right? The expectations operator. Well, what probability is associated with this guy right there? Sorry. Well, there's a 60% probability associated with that. What probability is associated with that? 40, right? So basically, you know, a 60% probability associated with that, 40 of that, multiply them, add them up, and I would get the covariance. In this example, would be minus 0.00144. Now, as I mentioned, that's an example where it was countercyclical, and it's easy to teach it that way. The covariance is negative, so it's more intuitive that it's risk reducing. Okay, but as I said earlier, even if the covariance had been positive, it would still mean less risk, because that risk interaction, than the sum of two people just holding two securities separately. And by the way, let me go back a second. By the way, at this point, I could not tell you what that minus 0.00144 means. Okay. Now later on, I'm going to make up for that. But unless I just regurgitated the formula, you know, translate it into English words, I couldn't tell you what it really means. Unlike earlier on when we were talking about correlation, you know, correlation of minus 1 means that when A goes up by 1%, B goes down by 1%. That you can translate into English. At this point, covariance, you cannot translate that into English. But like I said, I'm going to make up for that later on. So let's go to, let's look at portfolio risk. Okay, we're going to start off with just two securities. And then we're going to add, say, IBM. We'll see how much risk is added. Okay, again, our goal is to isolate, well, how much does any single security, like say IBM, contribute or add to a well-diversified portfolio. So When we were in the world of just one stock, say IBM, how do we quantify its risk? You remember? By its variance, right? Well, now we've got two securities. So do we need to consider the risk interaction that happens between the two securities? We do, right? And how do we quantify, for example, the risk interaction between Home Depot and IBM? By the covariance between the two. So let's say we have two securities. We've got security A and we've got security B. Well, does A have a variance? It does, right? Does B have a variance? It does, right? And is there a covariance between the two? Is there a covariance between A and B? There is, right? And so if those are all risk factors, does it seem intuitive or reasonable that I should or should not include them as part of total portfolio risk? Well, hopefully it does seem intuitive. And I agree, I'm doing some hand waving here, trying to keep things simple. But I'm relying on the fact that it does seem intuitive that these are all relevant risk factors that would go into total portfolio risk. So if I look at my portfolio, I have two securities, A and B. What would go in the AA box? A variance term or a covariance term? A variance, right? The variance of what? A or B? Well, the variance of A. What about the BB box? What would go there? Well, presumably the variance of B. And what about the two AB boxes? Well, presumably the covariance between A and B. By the way, the covariance between B and A is the same as the covariance between A and B. So there's nothing important about which letter you put first. So at this point, we've seen that these are all the relevant risk terms. So for me to get total portfolio risk, can I add up all these boxes? It's a tough question, right? Well, do you think it matters how much of my money I have in A and how much in B? I mean, what if I had all my money in A and nothing in B? Then would these three even be relevant, covariance and variance? It wouldn't, right? And I'd just be stuck with variance. So from that perspective, the amount of money or the percentage of wealth that I have in each stock, would it seem relevant? It would, right? So I couldn't just add these up and say this is total portfolio risk, because it's going to depend upon how much money I have in A and B. So what would I do with that information? Well, presumably I'd want a weighted average of all of these guys. And in the end, whatever weights that I apply to these guys to weight each and every one of them, the sum of the weights should add up to what? They better add up to 100%. Otherwise I'm double counting, right? And if they add up to less than 100%, then I'm undercounting. So the question is, how do you apply a weighted average? How do you get the weights for a two-dimensional matrix? Well, let me illustrate. Suppose I had 60% of my money in A and 40% in B. Well, the way you basically figure out what weights to apply here is you multiply the rows in the columns. So here I have a 60, here I have a 60, so the weight that I would put here is 0.6 times 0.6, and so on and so forth. So let me illustrate. The weight that I would put here would be what? 0.6 times 0.4. And what about here? What would I put here? Well, 0.4 times 0.6, right? Or 0.6 times 0.4, same thing. And what would I put here? Well, this 0.4 times this 0.4. And so if this is all working, then these four numbers, 0.36, 0.24, and that, they better add up to what? As I mentioned earlier, they better add up to 1. Well, let's see. If I take this 0.36 and this 0.24, I get 0.6. If I take that 0.24 and I add this 0.16, I get 0.4. And of course, if I add these guys up, I get 1. So this is going to work out every time. You could put 70% here and 30% there, and you'll see it always adds up to 1. Hey, great idea. Why don't you just pause right now, or as soon as you get home, or whatever, next break, try it a bunch of times. Sounds exciting, right? In any case, that's how you get the weights of a two-dimensional matrix. So just to remind you, remember without the weights, we had these variance and covariance terms. So if I now add weights, and I say, all right, well let's let WA and WB be the percentage of wealth that I have in A and B. So the numbers I used earlier, for example, this was 60% and this was 40%. Then what would I put in front of this variance term to weight the variance? Well, WA times WA, right? Or earlier with the numbers I used, 0.6 times 0.6. And what about the covariance boxes? What would I put here? WA times WB, right? And what about here? Well, WB times WB. So now, can I add up all of these guys to get total portfolio risk? Yeah, now I can do that, right? And if I do that, I'd basically get, this variance term, this weighted guy, this weighted guy, and then what about these numbers? Are they identical? They are, right? WA times WB times the covariance. They're identical, so it's basically the equivalent of 2 of these guys. So my total portfolio risk is going to look like that. So we've achieved our goal of figuring out total portfolio risk. And again, why did we want to know total portfolio risk? Well, we want to know how much does any single security add or contribute to this total portfolio risk. So in this example, we've got 4 boxes. 1, 2, 3, 4. How many of those boxes can I apply to security A? Well, would I want to include this one? Yeah, probably, right? What about this one? Yeah, well, you're probably thinking, yeah, the covariance between A and B, yeah, that's relevant. What about this one? Would I want to include that also? And you might be thinking that's relevant. But if I give these 3 boxes to A, then how many boxes are left for B? Well, just this one, right? And is that fair? If I have 4 cookies and I give 3 cookies to my daughter and 1 cookie to my son, what's my son going to say? That's not fair, right? So what does make more sense? Well, certainly this guy would apply to A, right? The variance of A. Is it fair to say that, well, maybe one of these guys should apply to A and the other to B? So if we wanted to, we could take these 2 and say, hey, that's the risk that A contributes. Or we could take these 2 and say that's the risk that A contributes. And so that's basically the logic. I'll go along the road. It doesn't matter because this is the same as this. So basically that's the risk that A adds. And if that's the risk that A adds, then if these 2 are for A, then what is for B? Well, these 2 right there, right? So here's my question. If this is the amount of risk that B contributes to this portfolio, can we now say that that is B's non-diversifiable risk? Well, the answer is no. Why not? Is this portfolio well diversified? It's not, right? And what was the definition of, say, IBM's non-diversifiable risk? The amount of risk it contributes or adds to a well-diversified portfolio. And at this point, this is the amount of risk that B adds to just a portfolio of 2. So in other words, it's not well diversified. So in other words, we've got more work to do. Now, in theory, how many financial securities are in a well-diversified portfolio? Basically, the market, right? Or an infinite number of financial securities. So our goal is to see, well, how much risk does any individual security add to a portfolio that's well diversified? So in other words, we're going to start having to add more and more securities and to see how much risk any given single security adds. Now, as I proceed with the following slides, just to make it simple so it's easier to read, I'm going to pretend I have all these weights in here. So in other words, pretend there are weights here, and I'm going to say this is the risk that A contributes, and that's the risk that B contributes. So where we are right now, with two financial securities, if we look at how much A contributes, how many variance terms do I have, and how many covariance terms? Well, I have one variance term and one covariance term, right? So let's see what happens when we add another security. So now we have three securities. Well, what terms go in the AC boxes? A variance term or a covariance term? Covariance, right? Covariance between what? Well, between A and C. What about the BC boxes? What goes there? Variance or covariance? Covariance, right? Covariance between what? Between B and C. And finally, what about the CC box? A variance term or a covariance term? A variance. The variance of what? Variance of C. So now what could I say is the risk that A contributes? Would it be this row right here? It would, right? So that's the risk that A contributes. So now I have three securities, and if we look at the amount of risk that A contributes, how many variance terms and how many covariance terms do we have? Well, we have one variance term, and then we have these two covariance terms. So can I now say, well, all right, this is the amount at risk that A contributes to this portfolio. Can I now say that this is A's non-diversifiable risk? I couldn't, right? Why not? Because this portfolio is not well diversified. Again, in theory, how many securities do we need for a well diversified portfolio? An infinite number of financial securities. So let's move in that direction. Let's add another security. So again, where do all the covariance terms go? Basically everywhere except this bottom box, right? So we've got the covariance between A and D, and B and D, and C and D, and then finally the variance term goes at the bottom right there. So now we can say this is the risk that A adds. And how many covariance and variance terms? Well, one variance term and then these three covariance terms. And if I add another security, I'll have one variance terms and how many covariance terms? 4, right? And what about if I add the market? If I go all the way out to an infinite number of securities, every time I add another security, I go all the way out to infinity. How many variance terms will I have with as far as what A contributes? 1, right? And then how many covariance terms? Well, basically, an infinite number of covariance terms. I mean, I guess you could say infinity minus 1. You know, same difference, more or less. So here's my question. Okay? Now, at this point, first of all, at least by assumption, is this a well-diversified portfolio with an infinite number of financial securities? It is, right? And so we said that A's non-diversifiable risk was the amount of risk that it added or contributed to a well-diversified portfolio. So now we have a well-diversified portfolio, and the amount of risk that A adds is basically, you know, one variance term and then an infinite number of covariance terms. So this is where, again, I'm going to do some hand waving. We're not going to get into a lot of fancy mathematics. To be honest with you, I'd have to go back and look at my old PhD notes to even, remind myself all the mathematics. So I'm just going to rely on intuition. So I have one variance term, and I have an infinite number of covariance terms. All these risk factors. Now, what do you think dominates? Is this one risk factor here, or these infinite number of risk factors there? Well, presumably, it's intuitive that an infinite number of risk factors would dominate over one single risk factor. And so we basically ignore this variance risk factor, and we say, great, well, the amount of risk that A contributes to a well-diversified portfolio is basically the covariance between itself and all other financial securities in the world. Okay, or an infinite, if you want to be technical, -1 financial securities. Well, what do we call this? What do we call these other infinite number of financial securities? Call that the market, right? And so therefore, the amount of risk that A contributes to a well-diversified portfolio is the covariance between itself and the market. And that's how we've defined non-diversifiable risk. Now, we've still got one more thing to do to make it manageable to work with this, because if you recall, I told you earlier that if I told you that, say, the covariance between, say, A and the market was, I'm just making up this number, was 0.0023, I couldn't tell you in English what that really means unless I just regurgitated the formula verbally. I mean, it's kind of like this. If I told you, hey, a company made $1 million in profits, would that be happy face? Would that be sad face? Or would that be I don't know face or poker face? Be I don't know face, right? Why would it be I don't know face? Well, you need some kind of benchmark, right? I mean, if I told you that was IBM, made $1 million in profits, happy face or sad face? That'd be sad face, right? Because I'm used to making tons more money than that. But if I told you it was my lemonade stand, happy face or sad face? It'd be ecstatic face. I'd be thrilled. Okay? So in other words, you need a benchmark. Another way of putting it is maybe a company makes $1 million in profits, and the way to give it a benchmark is you divide it by sales. That's just one way. I'm just making something up. So maybe $1 million in profits from 10 million in sales. So now you have a percentage profit margin. It provides a benchmark. And so similarly, here we have a risk term, and to make it meaningful, we need to benchmark it against something, or standardize it against something, whatever you want to call it. So how do you think we standardize it? I mean, if you think about my example of the profit, $1 million, and I divided it by sales, $10 million, am I taking a dollar value and dividing it by a dollar value? I am, right? And here, this 0.0023, is that a type of risk number? It is, right? So if I wanted to benchmark it against something, or divide it by something, would I want to benchmark it or divide it by another risk number? Presumably I would, right? Using that same concept. So what kind of risk do you think should be the benchmark? So imagine A is IBM. Okay? So I should maybe benchmark it or standardize it against the risk of Apple? That'd be kind of random, right? Ad hoc. Divide it by the risk of Lowe's? That'd be kind of random. Can you think of anything? What about the market? What about the variance of the market? And so essentially, when you take the covariance between a single security, say IBM in the market or A in the market, and you divide it by the variance of the market, now you've got something called the beta, or in this example, the beta of A. And now, I can tell you what that means in English. For example, if I told you the beta of IBM was 2, what does that mean? Well, that means that if the market went up by 1%, you'd expect IBM to do what? Go up by 2%. What if the market went down by 1%? Then you expect IBM to do what? Go down by 2%. So in other words, beta is sensitivity to market movements. So now that I got beta, I can easily translate it into English. So now we've achieved our goal of quantifying non-diversifiable risk, and that is by any individual's securities beta. The amount of risk that it contributes or adds to a well-diversified portfolio can be quantified by its beta. Now, earlier on I made up probabilities of booms and recessions and so on and so forth, and in the end our goal was, well, part of our goal was to get beta. So in real life, how would you calculate beta? Now that you know what beta means, sensitivity to market movements, how would you calculate it? Now, some of you who are probably more mathematically oriented and formula driven are probably thinking, well, I'd take the covariance between, you say, IBM and the market, and I'd divide it by the variance of the market, and yeah, you'd be regurgitating a formula, which is fine. But think about what the term means in English. It means sensitivity to market movements. So if the market changes by a particular amount, if on average the stock changes by a particular amount, given that, what two pieces of real-world information would we need to figure this out? Well, would we need market prices? You know, as a proxy, maybe we use the New York Stock Exchange Index or the Standard, the S&P 500 or whatever, and would we also need IBM's stock prices? So in other words, maybe time zero is today, and maybe we go back 100 days, and maybe 100 days ago when the New York Stock Exchange Index went up by 1%, maybe IBM went up by 1.5%. Maybe the next day the market dropped by half, and IBM dropped by 1.1. And if I wanted to, I would have 100 or 101 points of data there. Could I basically plot a graph? Here's all these points, and the line that most closely fits between those two. If it turned out that on average, when the market went up by 1, IBM went up by 2, that's IBM's stock, then what would be the IBM of the beta of IBM? It would be 2, right? And by the way, this is an estimation. And we'll get into that in more detail later on. But in theory, that beta should be about the now and the future. Just like a stock price. The stock price today, that's the now, is a reflection of the future. That's what it is in theory, right? But to estimate beta, what are we forced to use? We're forced to use historic data. And in real life, this is how you would calculate, or one way of calculating beta, but you're forced to use historic data. So now we've quantified non-diversifiable risk by its beta. We've said, well, we've got this risk, so what do we want to do with it now? Well, we said it was part of that pricing sentence, right? We said that with higher risk, or non-diversifiable risk, we require a higher return. So what we need to do is we need to develop an equation or some kind of mathematical model where if we have the beta, that out will pop the required return. And if that required return was, say, 15%, then what would be the discount rate for IBM? 15%. And that was our goal, to figure out the discount rate for financial securities. And why did we care about the discount rate for financial securities? Again, because obviously I already forgot. Well, is it highly related to the discount rate for the asset investment decision? It is, right? And why do we care about the discount rate for the asset investment decision? Because it's half of what you need to know to do a net present value, which is cash flows and a discount rate, which is some bottom line analysis, if you will, for what is arguably the most important decision a firm makes, and that is the asset investment decision. But right now, we have we've quantified beta, so we've got the relevant risk. We need to map it or come up with a formula for what puts it into required return. Does anybody know the name of a model that does that? Well, there are different models out there, and what we'll do is we'll talk about the capital asset pricing model. By the way, in case you're wondering, that's a model. Okay. So linking risk with required return. So here we begin with, I'll put risk on this axis, and now we know that's quantified by its what? Its beta. And I'll put required return on that axis. So let me ask you this. Suppose I had a security with no risk. Then what would be its beta? Well, no risk, the beta would be 0, right? What that would mean is that, hey, it doesn't matter what the market does. It's going to be the required or expected return or whatever is going to be totally insensitive to market movements. Can you handle can you handle an example that is maybe not completely compos mentis, whatever the expression is? All right, I'll risk it. I'll give you an example. Let's say we take my toothbrush that I have been using for maybe a week or two now. That might be an understatement. Anyway, so I say to you, hey, how much will you buy my used toothbrush for? And you're probably going to gross. Are you kidding? I'm not going to pay you anything for it. Oh, all right. Okay, great. Well, what if the market just went through the roof? I mean, it jumped, 1,000 points. Now how much would you pay for my toothbrush? Nothing, right? And what if the market just plummeted 1,000 points? Now how much would you pay for my toothbrush? Nothing, right? In other words, the value of my toothbrush is totally insensitive to market movements. And so what would the beta of my toothbrush be? It'd be 0. Now, as far as financial securities, being a little bit more real world about this, what is the closest, or what is considered to be, some might argue with this sometimes, but what is considered to be the closest thing we have in real life with 0 risk? Basically, a US T-bill, right? Because the probability of default, and in real life there exists a probability of default even with the US T-bill, but the thought process is, well, the government could always print money and pay off their debts, although of course you can't do that indefinitely. Look at Zimbabwe. So the point is that even when there's 0 risk, do investors still require a return? They do, right? And like I said, the closest thing in the real world might be, say, a US T-bill or some other credible government's T-bill. And so I'll denote that as RF, being the risk-free rate. And just to use simple numbers, why don't I imagine it's 5%? So I'll do this with both numbers and with symbols. So at this point, we've linked 1 point on this graph. Something with 0 risk has a required return of 5%, or the risk-free rate. Now suppose I hold the market portfolio. Well, what's the beta of the market portfolio? Well, the sensitivity of the market with itself is what? The market goes up by 2%, it goes up by 2%, so sensitivity of the market with itself is 1 to 1, and therefore the beta of the market is what? It's 1, right? So is it true that when I go from a risk level of 0 all the way to 1, that investors would need to be bribed, if you will, with higher required returns for taking on that additional risk? They would, right? And imagine that they have to be bribed or rewarded with 10% additional return, which, by the way, is called the market risk premium. So now we have 2 points that maps risk with required return. We could say the required rate of return of the market is that 15%. Or another way of putting it is, all right, where do we get this 15 from? Well, we began with 5 for taking on no risk. And then basically we added this market risk premium, which is the difference between the 15 and the 5, which is what we have here. Or in symbols, the risk-free rate plus the difference between the expected market return and the risk-free rate. So that's what we're looking at so far. And so we have 2 points now where we link risk with required return, which is not that useful. We want to be able to do this for any security, right? Well, what if you had a security that was, say, twice as risky as the market? Well, what would its beta be? It'd be 2, right? And if you had a security that was twice as risky as the market, then would it seem reasonable or unreasonable that they should get twice this reward? Well, presumably, it would be reasonable. So if we had something with a beta of 2, then on this equation right here, for example, where would I put the 2 if I'm going to get twice this reward, this 15 minus 5? I'd put it right here, right? And therefore on this equation, where would I put the beta? Put it right there, right? And so if IBM had a beta of 2 and you wanted to know the required or expected return of IBM, then you'd basically have that equation right there. Or in our example, the required or expected return of IBM would be 25%. And so therefore, what should IBM's discount rate be? 25%. And that was our goal, to figure out the discount rate for financial securities. So there we have the capital asset pricing model. This is also called the security market line. And so let's discuss this a little bit. First of all, what's the implication of this line being upward sloping? Well, not complicated. Hey, higher risk, we require higher returns, right? But what about the fact that it's a straight line? So, for example, if you'll indulge me a second with another diagram. Hang on 1 second. So here I have returns and risk. Okay. Is this upward sloping everywhere? Okay. Is that upward sloping everywhere? It is, right? And so could I also say for that line with higher risk, we require higher return? We could, right? But notice right here, okay, if I take on a little bit more risk, I only require a tiny little bit more return. But right here, if I take on the same amount of little more risk, I require a whole bunch more return. So where is the price of risk more important? Where I require a whole bunch more return or just a little bit more return? Presumably where I require a whole bunch more return. So you could say that risk is priced high there and it's priced low there. Now, what kind of opportunity does that exist, or does that present, when at a point in time, because this whole cap equation, is that an instant snapshot? It is, right? This line here is an instant snapshot. For example, on a second-by-second basis, does the T-bill rate change? It does, right? So is this going up and down just like stock prices on a second-by-second basis? It is, right? And what about the slope of this line? The slope of this line saying, hey, for a little bit more risk, I require a little bit more return. Is that like a pricing sentence? For more risk, I require more return? It is, right? And do you think the price of risk changes on a second-by-second basis? It does, right? So I hate to be morbid, but when those planes flew into the towers, did the price of risk remain static or dynamic? It was dynamic, right? It changed. So here we have, at a point in time, if it were not a straight line, at a point in time, you have risk that's priced high and risk that's priced low. You could argue that represents an arbitrage opportunity. Well, what do I mean by arbitrage opportunity? Well, let me give you another quick example. I'll just cover arbitrage real quick. I'll give you an example of riskless arbitrage. Suppose we have IBM, and on the New York Stock Exchange, I'll show you this diagram in a minute, and I have no clue where they're trading. Let's say $100 a share. And on the London Stock Exchange, after you adjust for exchange rates and transaction costs, etc., yeah, maybe it's $98 a share. Okay, so here we have $100 a share and 98. So with one push of the button, could you be buying at 98 and selling at 100? You could, right? And so if everybody's buying low and selling high, what a concept. If everybody's buying in London, then what do you think would happen to the price in London? It'd go up. Maybe it goes up to 99. And if everybody's selling in New York, what would happen to the price in New York? It'd go down, right? Maybe it goes down to 99. Okay? So this point here where you had 198, that represents an arbitrage opportunity. That means that you expect to beat the market on a risk-adjusted basis. As we talked about earlier in the, I think it was the valuation of stocks and bonds lecture, we talked about this whole concept of market efficiency. When you have an arbitrage opportunity and you expect, therefore, to beat the market on a risk-adjusted basis, is that an example of a market efficiency or market inefficiency? Market inefficiency. And so if we get back to this diagram right here, where at a point in time you have risk that's priced high and low at the same time, that too, does that represent an arbitrage opportunity? It does, right? Because it means one security is relatively speaking underpriced and the other one is relatively speaking overpriced, which is not the same as my IBM example, because that would be an example of riskless arbitrage because it was for the same security. But if you could somehow identify a security that was relatively overpriced, another one that at the same point in time was relatively underpriced, that would be an example of risky arbitrage. And in neither case would they be consistent or inconsistent with market efficiency. Inconsistent. And so the fact that I have this as a straight line means that the CAPM model has built into it the assumption that prices are efficiently priced, or at least that there are no arbitrage opportunities. So the fact that it's a straight line means the price is the same for all securities. For all, so whether you have a low risk security or a high risk security, the price of risk is the same. And so in our example, just to illustrate, on a per beta basis, when I go from 0 to 1, I'm getting a reward of how much? With the market risk premium, right? And as I mentioned, what kind of opportunity would exist if the price of risk were not equal for all securities? Well, an arbitrage opportunity. Now, I told you earlier that I would differentiate between expected return and required return. And so required return, by definition, is anything on this line. Okay, so when you have a risk level of 2, what is required in a sense by the market just to break even, if you will, 0 MPV, is this much right here. Or if we use this example, if you have a beta right here, just to break even, what is required is this return right there, just to break even. But what if for some reason you personally expected something higher than what was required? So you bought Apple stock and the required return just to break even was, say, 10%, but you had information, or you, for whatever reason, you expected 15%. Well, would that motivate you to buy Apple stock? It would, right? Because for whatever reason, you're expecting something bigger than what the market required given the risk inherent in Apple. And so if you're somebody who personally believes, hey, what I expect is what is required, then are you essentially believing that Apple is efficiently priced? You are, right? And so basically, in an efficient market, if you believe the market's efficient, your expected return will be your required return. I mean, your expected return will be the market's required return. What that means is if Apple's priced at 500 when you buy it, at the time you buy it, if you believe it's efficiently priced, do you expect to either beat or lose to the market? No, you don't. I mean, in the end, you'll either get lucky and you will beat the market, or you'll get unlucky and you'll lose to the market. But at the time you buy it, if you believe it's efficiently priced, there's no reason to believe that you'll get lucky or unlucky. So basically, in an efficient market, the expected return is the required return. Now, there's one more thing I want to discuss with this whole model, and that is the fact that it's not testable. In other words, I can't take this model, apply it to real-world data, and say, aha, you see, this works with certainty. Or I cannot take this model and go, aha, you see, it doesn't work. Now why is that the case? Well, as we discussed earlier, in theory, not in practice, but in theory, is this model about the now and the future, or is it about the past? In theory, it's about the now and the future. In fact, a really good analogy for betas is stock prices. Beta is a reflection of risk, right? It is. And if you look at stock prices, do stock prices change on a second-by-second basis? They do, right? And do they change on a second-by-second basis as a reflection of future expectations and the risk inherent in those future expectations? They do, right? And it's the same thing with beta. Beta is a now and future number. The market's saying right now, hey, in theory, this is the beta right now, this second, sort of analogous to the stock price, reflecting expectations of risk in the future. And so when we look at this model and we say, well, it's not testable, well, let's look at what is available to test it. Well, let's look at this guy right here, the risk-free rate, the T-bill rate. Is now and future data available for the risk-free rate? It is, right? Or the T-bill rate. So for example, if, and I'm making this up, indulge with me again, 1 second, sorry. But so for example, suppose that a T-bill today cost $1,000. So a T-bill today costs $1,000. And then in 1 year, you expected to get $1,100, and then the T-bill thing was over. Okay, so given it cost $1,000 today, what discount rate does this reflect? 10%, right? Because 1,000 at 10% grows into 1,100. So in other words, the required rate of return for this T-bill rate would be 10%. Is that a now and future number? It is, right? The 1,000 that it's priced for right now this second, which by the way is changing on a second-by-second basis, that's the now, and the 1,100 is what it's expected to pay off when it matures. So T-bill rates have now and future data. What about beta? In theory, we want a beta that is what? About the past? Or in theory, reflecting the now and the future? in theory reflecting the now and the future. But does there exist a ticker tape of betas out there that says, hey, right now this is the beta of IBM, and 1 second later this is the new beta of IBM? Does that exist? It doesn't, right? So in other words, we are forced, and that's one of the weaknesses of this model. And there are other models, like I said, and they also have weaknesses. Different models have different weaknesses. And so there are weaknesses inherent in the application of this model because we're forced to use historic data to estimate what goes into this number right here, reflecting the now and the future. And what about this guy? Is there a ticker tape of saying, hey, right now, this second, the market risk premium or the reward for going from 0 beta to 1 beta, a beta of 1 is 10%. Is that reward or the price of risk, is that going to change on a second-by-second basis? It is, right? But is there a ticker tape up there somewhere telling us what it is? There isn't, right? So again, for this difference here, this gap, we are forced to use historic data to estimate what the market risk premium is. And so the reason this model is not testable is because somebody could go out and get the data and they'd say, you see, it works. But then you could say, well, how do you know? Because you don't have something that perfectly replicates what the beta should be, or you don't have something that perfectly replicates what the market risk premium is. Or somebody could go out and get data and they say, see, it doesn't work. And you could say, well, maybe it does. I mean, you just got the wrong data, right? And so essentially, I just want to point out that this model is not the end all. It definitely has its weaknesses, but it is something that's also used in the real world. So in any case, we've achieved our goal. Our goal was to get the discount rate for financial securities. To kind of summarize, we basically said, all right, well, when it comes to financial securities, we assume that investors care about what two things? We assume that they care about risk and return. And we said, all right, well, with higher risk, investors require higher return. And if that return is, say, 10%, then what is the discount rate for the financial security? 10%. And why have we even gone through all this? Why do we care about the discount rate for financial securities? Well, because it's highly related, as we'll find out in the final lecture coming up next, it's highly related to the discount rate for the asset investment decision. And why do we care about the discount rate for the asset investment decision? Because some bottom line analysis that applies is what's called net present value, and what two things did you need to do a net present value for an asset investment decision? Well, you needed cash flows and a discount rate, i.e. the discount rate for the asset investment decision. But you cannot understand, of course you can memorize, but you cannot understand the discount rate for the asset investment decision unless you understand the discount rate for financial securities. And so that's why we've gone into the depth that we've gone into. So with that in mind, I hope this was a good learning experience, and I'll see you at the next lecture, which is the discount rate for the asset investment decision. Thank you.